Today, US stock market is sitting on a pile of 72 trillion US dollars, out of which 6 major IT companies are contributing 30% of the weightage. To put up in a perspective, the top 10 listed companies are contributing 33% of the total market share, which is highly concentrated in S&P 500 index. Just look into the graph. Nvidia alone is contributing 7.1%, followed by Alphabet, Apple, Microsoft, Amazon, etc. To deep dive into this, I have divided the total video into 3 aspects. One is quarterly earnings versus capitalization. Second is forecast, where these companies are making huge AI bets. Third is the risk, what if something goes wrong. So recently these companies have posted their quarterly earnings where they have shown a tremendous good results. Based upon the critics, this is an AI bubble, but they have come up with the real numbers. This is proving that these companies are profit making machines, not just some bubble here happening. For example, Alphabet has come up with 22% of year-on-year revenue growth, out of which 68% of the growth is coming from Google Cloud Services. Meta has shown 33% of year-on-year growth, which is tremendous, and this is from AI-led specific advertisements reaching to the customers specifically. Microsoft with 18% of year-on-year revenue growth, where the majority of the revenue is driven by AI-led Azure cloud services. So all these companies are saying that the AI is playing a major role here. Finally, Nvidia. Look into the numbers. Nvidia has posted 114% of year-on-year revenue growth, which is marvelous. Most of the companies are struggling to get 10% of the growth, where they celebrate Nvidia is reaching these numbers. This is really remarkable. Now let us look into the forecast. These companies are hugely betting on AI. So recently Meta has posted that they are going to establish data centers worth of $145 billion. Incredible, marvelous. But according to analysts and experts, why these companies are getting this confidence is AI. How they are forecasting is that the main 3 pillars what they are looking into is AI computing, where the businesses are transferring their entire workflow into AI-led cloud services. Second is the AI subscriptions. I mean to say AI agents like the Microsoft Copilot and Claude subscriptions have become just regular phone bills nowadays. The third is hardware shuffle. These companies like Apple with Apple Intelligence and many other computer manufacturing companies are coming with AI integrated PCs. So by 2027 the expectation is majority of the computers in the world will be AI integrated. This is a huge hardware shuffle. These are what the companies are betting upon. The third, let us discuss on the risks. Everything is going good. Let's say something goes wrong. What happens? Based on the historical events, whenever the market capitalizations get concentrated, it is seen that there is a trigger of recession or a sharp fall in markets. So what are the indicators we have to look into? The first indicator is the recession indicator. The market has peaked during 1970s before the fall. Then in 2000s during the .NET bubble, and also the same like in 2008 the Lehman Brothers falls. So all have showing the similar patterns. Market capitalization gets concentrated, then it will result into a sharp fall. So that is where we have to see whether the market has reached its peak point or not. That is one. The second is the index trap. Most of us will invest into S&P 500 index funds, where we are unknowingly investing into these companies. So it is a kind of, what you will say, unknown incidents which are happening with us, and it is all coinciding to one incident. The third what we have to look into is the capex cliff. let's say the Meta, Google and all, now they are betting huge on AI and the investments are huge, like 145 150 billion dollars. But what if something goes wrong and the profitability doesn't turn up by 2027? It will be a huge violent market then. So these are few indicators where we have to look into and have a regular monitoring to adjust our risks. Now let's conclude the video. What are we going to do as a basic investor, as a smart investor? What I'm going to do is, are we going to sell out the stocks? No, not absolutely. Because the history is also saying that whenever such concentration happen, these companies have always outperformed the strategies and came up back. So it is a positive thing. Being a smart investor, you can do one thing is that the diversify the funds into small caps, mid caps, hard assets, etc. Also mixed cap funds where these companies will have just 2% or 3% of the weightage, not like 33% as of the index. So now these companies are taking a huge load of the world on their back. It is a spectacular show. But what if something goes wrong? We all must have our safety nets with us. Ultimately, money is valuable to everyone. So be safe. Thank you. Finally, if you like the video, please like and subscribe.